Lesson: Addressing risks in joint ventures and partnerships. Joint ventures and partnerships present unique opportunities for businesses to innovate, expand, and share resources. However, these collaborative business structures also come with inherent risks. Addressing these risks effectively is crucial for ensuring the success and stability of the partnership. The key to mitigating risks in joint ventures and partnerships lies in understanding potential challenges, applying strategic frameworks, and using practical tools to address them. Risk identification is the first critical step in managing joint venture and partnership risks. Common risks include cultural mismatches, misaligned objectives, resource imbalances, and regulatory compliance issues. For instance, in a joint venture between two companies from different countries, cultural differences can lead to misunderstandings and conflicts. Misaligned objectives can arise when partners have different expectations regarding the venture's goals or timeline. An effective way to identify these risks is through a comprehensive risk assessment framework, such as the risk breakdown structure, which categorizes risks into manageable segments. Once risks have been identified, they must be assessed to determine their potential impact and likelihood. The risk matrix is a practical tool for this purpose, offering a visual representation of risks based on these two dimensions. By plotting risks on the matrix, companies can prioritize which risks require immediate attention. For example, if a joint venture faces a high likelihood of regulatory changes that could impact operations, this risk would be placed in the high-impact, high-likelihood quadrant, necessitating urgent action. To address identified risks, companies should develop risk mitigation strategies tailored to each specific threat. One effective approach is the use of scenario planning, which involves creating detailed narratives of potential future states and developing strategies for each scenario. This method allows partners to anticipate changes and prepare flexible responses. For instance, a partnership could use scenario planning to prepare for potential regulatory changes by developing contingency plans that include alternative operational strategies or renegotiating terms with stakeholders. Another essential framework for addressing risks in joint ventures and partnerships is the governance framework. This framework outlines the roles, responsibilities, and decision-making processes within the partnership. Effective governance ensures that all partners are aligned and that there is a clear process for resolving conflicts. For example, a joint venture could establish a governance committee consisting of representatives from each partner organization tasked with overseeing operations and making strategic decisions. Communication is a critical component of any successful partnership. Miscommunication can exacerbate risks and lead to misunderstandings. To address this, partners should establish clear communication protocols, including regular meetings and updates. The use of collaboration tools such as project management software can enhance transparency and ensure that all partners are informed of progress and potential issues. For example, tools like Trello or Asana can help track tasks, assign responsibilities, and monitor the progress of joint venture projects. One of the most significant risks in joint ventures and partnerships is the potential for financial disputes. To mitigate this risk, partners should develop a comprehensive financial plan that includes clear guidelines for revenue sharing, cost allocation, and profit distribution. Financial modeling tools can be used to simulate different financial scenarios and assess the potential impact of various strategies. For instance, using Excel-based financial models, partners can evaluate the financial viability of different project proposals and make informed decisions. In addition to financial risks, regulatory compliance is a critical area that requires attention. Non-compliance can result in fines, legal action, and reputational damage. To address this, partners should conduct regular compliance audits and implement robust compliance management systems. These systems can help track regulatory changes and ensure that all operations adhere to relevant laws and standards. For example, implementing a compliance management software, such as SAP GRC, can help monitor compliance activities and generate reports for regulatory bodies. Real-world examples illustrate the importance of addressing risks in joint ventures and partnerships. The joint venture between Daimler and Chrysler serves as a cautionary tale. Differences in corporate culture and management styles led to significant operational challenges, ultimately resulting in the dissolution of the partnership. This case underscores the importance of cultural alignment and effective governance in mitigating risks. In contrast, the successful partnership between Starbucks and Tata Global Beverages highlights the benefits of effective risk management. By aligning their strategic objectives and leveraging each other's strengths, the partnership has successfully expanded Starbucks' presence in the Indian market. This example demonstrates the value of strategic alignment and effective communication in managing partnership risks. Statistics further highlight the importance of risk management in joint ventures and partnerships. According to a study by McKinsey & Company, nearly 70% of joint ventures fail to achieve their initial objectives, often due to poor risk management and misaligned goals. These figures underscore the need for a structured approach to risk management, using tools and frameworks to address potential challenges proactively. In conclusion, addressing risks in joint ventures and partnerships requires a comprehensive approach that includes risk identification, assessment, and mitigation. By employing frameworks such as the risk breakdown structure and governance framework, and utilizing tools like the risk matrix and scenario planning, companies can effectively manage risks and enhance the success of their partnerships. Real-world examples and statistics further illustrate the importance of these strategies in mitigating risks and achieving strategic objectives. By applying these actionable insights and practical tools, professionals can enhance their proficiency in managing third-party risks and contribute to the overall success of their organizations.